Just the ability to have cash on hand and not have to manage cash so closely. What does that open up for the founder's mindset alone, right? To just have some extra cash on hand to go out and hire whoever they want, account executive, SDR, because a lot of it can be psychological, just the ease of access into getting rid of other things that you're working on, whether that's sales or whether that's just acting like an accountant when you're the strategic CEO and trying to manage cash day to day. So yeah, it's not only these grand initiatives, sometimes it's just the ability to breathe, extend runway, to look ahead. Lighter Capital provides non-dilutive financing, mainly for B2B SaaS companies, but we can work with other recurring revenue types of model technology companies as well. Non-dilutive, that there's no warrants on our loan, there's no personal guarantees that the founder has to place, and there's minimal financial covenants on it.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Tanner Kovacevich, the VP of Sales, who's involved with all of the existing customers and new clients at Lighter Capital. They're a SaaS debt provider, very practical for many practical founders out there, several of whom I've had on the podcast here. So today we talk about the debt game. When should it be used? When does it not make sense? What are the misunderstandings? What do people need to understand to make sure it's got a great ROI for the founder? Which you don't hear about ROI for the founder with equity funding, VC funding, but it's one of those things that can be very useful in certain situations for practical founders. Lighter Capital is one of the friends and sponsors of practical founders. And today, Tanner answers a ton of questions. I know it'll be insightful. We have a ton of examples of how it was used successfully as well. Hey, Tanner, welcome to the Practical Founders Podcast.
Hey, thanks so much for having me, Greg.
We met briefly last year in Park City, Utah at your Lighter Summit event with a big room full of practical founders, learning from each other, learning from experts, learning from you guys. You and I didn't spend a lot of time together, but I just thought these are practical founders in your community around everybody that you're helping out there. So thanks for all the work you do for practical and non-practical founders out there. At Lighter Capital. Are you in the West somewhere? Where do you live these days?
Arizona. Yeah, I moved from Seattle about 5 years ago, where Lighter was initially headquartered. And then, like many companies, COVID happened. We went fully remote. So I chased the sun.
Yes. And you've been doing it long enough with Lighter Capital, which provides non-dilutive funding to practical SaaS founders out there. So you've seen a lot, and I look forward to picking your brain today on everything you're seeing from founders that fit your model and what doesn't fit, what's happening in the world, and all the variations. Let's just start off with, what is Lighter Capital? What do you provide at a high level, and who do you serve? And then we'll dig into some of the details around that.
Yeah, absolutely. So, Lighter Capital provides non-dilutive financing, like you said, mainly for B2B SaaS companies, but we can work with other recurring revenue types of model technology companies as well. Non-dilutive, in the sense that there's no warrants on our loan, there's no personal guarantees that the founder has to place, and there's minimal financial covenants on it.
So is it debt or is it debt-like? So it's clearly not like a VC investment or an angel investment equity that is dilutive, right? Dilutive funding, I guess you'd call it. But what specifically does Lighter offer to help founders in certain situations?
Yeah. So they're 3 to 4 year loans that scale based off your revenue. Right. So we're not underwriting your valuation or your potential projections. We're looking at the fundamentals of your business. We're looking at churn, concentration, runway, growth, all those types of things. And
profitability
then ultimately,
and things?
Yeah, profitability isn't a requirement.
Yeah.
90% of the companies we fund initially aren't profitable. They might
Mhm.
become profitable during the relationship with Lighter. But generally, we look at their ARR and you can get up to about 50% of your annual recurring revenue in a debt facility that can scale.
Okay. And how many companies has Lighter served? I know you guys have been doing this a long, long time,
Yeah.
and have helped hundreds of founders. But tell us the numbers here.
Yeah, so we financed 500 companies since 2010. That's when we started,
Yeah.
and we've done over 1,500 rounds of funding. So you can see many times we do multiple rounds and deployed about 500 million in capital now.
So not all, but of a lot of the founders get a little bit that helps them. They get a little bit more that helps them. They get a little bit more that helps them, and maybe scale that as they grow. They don't do it all in one chunk kind of thing. So it's not all of them, but clearly you're doing way more rounds or financings than you have the companies that you helped. So is that a typical thing?
Yeah, that's the nice thing about working with these practical founders, right? It's not how much can I get? It's they tell us what they need, right?
Yeah.
Me as the VP of sales, if they qualify for $1 million but want 500K, I might have someone from my team say, "Hey, is there any way we can get this, to a million?" And I say, "No." They have a plan with a clear return on their investment that they want to make. So you can start small with Lighter, try it out. Maybe it's their first time exploring debt, right? And to de-risk that, proposition, you can start small and grow it as needed. Because, yeah, we've done as much as 10 rounds of funding with a business in like a 4-year period.
Wow. So they just take little tiny doses, or in their terms, I guess you'd say.
Yeah.
Yeah.
Yeah, absolutely.
So what is your role there? I know the CEO Melissa. I know your
hmm
CMO Dave. I know Caitlin. You're the guy talking to all the founders and has a team that's doing it. Are you
hmm
doing that relationship after they apply? And is underwriting part of your world as well?
Yeah, I mean, we have a full underwriting team. I'm the VP of sales, so I manage a portion of my portfolio, which we have about 170 active clients. I don't manage them all, or I'd be
Yeah.
much too
Yeah, you and
busy.
your team. Right.
Yeah, the team. So we always, any given deal is paired with an underwriter. I've been with Lighter Capital for almost 8 years now.
Mhm.
I actually started probably the most I talked with founders was when I was a BDR at the
Yeah.
top of the funnel. So I'm talking,
Yeah.
10 conversations a day. And then I transitioned to our sales team and now I'm leading that team for the past about 24 months.
Okay. And generally, what are the steps when, founders are starting to hear about SaaS debt and royalty
Mhm.
based funding and SBA loans and thinking about that as one of the practical funding options here. But when they're thinking about it and they come to your website. I know they can apply. They can have a conversation really quickly. It's really straightforward what you guys do. But
Mhm.
why don't you explain what that looks like for a founder and what the experience is for somebody to see if it's a fit and see if it makes sense.
Yeah, we have a application in our website where you fill out some general details about your business. And then from there, you'll get scheduled with an investment director, which is really the person that's going to guide you throughout the funding process, really being the liaison between our investment committee and you as the founder and mainly an advocate for you throughout. After a call with an investment director, if we determine, there's a good fit, we'll set you up with a pretty simple, I'd say it's 5 to 10 minute underwriting application where we connect to your QuickBooks Online, which I'd say like 80% of the founders we worked with are using QuickBooks. So it's pretty simple click of a button. And then we get a churn report and a revenue by month by customer report. After we get all those things, we actually just take 3 to 4 business days to then get you a term sheet. After the term sheet, once we agree on that, of course, it's taken about usually 2 weeks or so to close. But
Mhm.
at least to see your option, as
Mhm.
you said, Greg, it's a really simple process, as quick as 3 to 5 days.
Well, I know a lot of SaaS founders use Stripe and these other payment processors, and there's some kind of get some cash into it, get some cash, right? It's always in our QuickBooks, get some cash kind of thing. Is that a gateway drug to what you guys do at Lighter? Better, faster, cheaper? Well, when I get started with those kind of simple debt facilities?
Yeah. Yeah, we see it. I'd say about 50% of the new deals that we do on a yearly basis have some component of what we call MCA debt, merchant cash advance. And how they work is, they might initially say it's a 12-month term, and you take a certain amount, but typically they get paid back Stripe by a percentage of your revenue. So if you're a growing SaaS business, you're going to pay that back much earlier,
Mhm.
which makes your cost of capital very high. Say, what we calculate is commonly 35 plus percent
Uh-huh.
APR, on
Wow.
these types of
So it's
facilities.
kinda credit card-like, right? You kind of use it because you could,
Yeah.
right? And have you get
Yeah.
the yeah.
Or worse, because there's an addictive nature to it almost from a cash flow perspective where, you pay that one off in 6 months and then you can click a button and get another, right? So we've seen, $5, $6 million ARR companies, have a decent amount of this MCA debt. And when we refinance it, they come back and say, wow, it's from a cash flow perspective, this makes a ton more sense.
Yeah.
So I think just look at the details of those loan documents and, really dig into how will I service this in my business, especially, if it's not a set payment and a percentage of your net cash receipts or revenue in another word.
Okay. So we'll talk about when does this make sense?
Hmm.
When does it not make sense? What do you gotta be ready for? What are the caveats here? This is funding, with a capital partner, and it's practical, but, like, this is a serious game. It's not for everybody. I'm not recommending everybody do it.
Yeah.
But, so you apply and you get some ARR zones and things like that. What range is a good fit for Lighter? There's all kinds of potential capital partners out there that have different ICPs, but what is the
Hmm.
range and the sweet spot for Lighter for the kinds of B2B SaaS companies, you help?
Yeah. Yeah. From an ARR size, I'd say like 1 to 5 million is our sweet spot, but we can
Yeah.
go much lower and start at 300K in ARR.
Okay.
Um, but I think, even more importantly than what the metrics might be, it's a founder that wants to start this long-term relationship. That wants to have someone that can scale with them over time and provide that optionality. That capital sequencing, I guess, to put a word to it.
Mhm.
Um, and we're not a fit for companies that are highly capital intensive, right? If you need to go out and raise 50 million and, it's a grow at all costs kind of mindset, might not be the best fit for you.
Yep.
But for companies that are slightly more capital efficient, maybe have a goal of getting to break even or profitability, that's where we can partner with businesses and really have a good relationship.
Okay. And so say it's a $1,000,000 ARR, B2B
Hmm.
software company. Maybe they have a little AI in there inside their business helping them run it faster and
Sure.
a little AI in the product, but it's got a recurring revenue model, monthly, annual, something like that. About what is the range? You say it's about half of their ARR, but what does a founder there usually start with? I know there's a range, but maybe
Yeah.
just give some shape for our audience here.
Yeah. So typically for companies kind of sub 3 million in annual recurring revenue, we can start as much as about a third of what their
Okay.
ARR is.
Yeah.
So call that like 333,000 and that could be a 3 sometimes 4 year loan.
Okay, 3, 4-year loan, and
Hmm.
not everybody's doing it that long, so you
Yeah.
get a chance to put money to something that you think is working or, and it'll provide measurable results and pay back the loan in that time, right? So you actually have to accelerate enough with the investment to pay it back, right? There'll be a
Mhm.
return there. So, what are the other common characteristics of a lighter, non-dilutive funding for the under 5 million ARR software companies?
Yeah. Really commonly, it would be a founder who has probably done it before, maybe more on the venture side. Did the old Silicon Valley
Yes,
tour,
they're converted to the
maybe.
practical universe. Yes.
Exactly. Yeah. So, oftentimes it's founders who've done it before. Usually it's somewhat niche platforms, right? Maybe it's a CRM specifically for distributors or, a
Just for
non-technical.
wedding planners, we had Rob Farrow, who used
Yeah.
Lighter multiple times on there, uh,
Yeah.
or just mapping for Salesforce.com sales forces to do, territory realignments. Map anything. That was John
Yeah.
Stewart. So,
Hmm.
back in the day, both on the podcast there, talked about Lighter and
Yeah.
using
Yeah.
Lighter
That was
efficiently.
awesome. You had John and Rob. Yeah.
Yeah, yeah. John eventually raised and sold to Salesforce,
Hmm.
and Rob and his wife, who created Aisle Planner for the wedding industry, grew it very efficiently, scrappy, right? She was the wedding planner influencer, and
Hmm.
they ran the business and eventually sold it. So very successfully, right? But they didn't
Yeah.
raise VC funding along the way. So very interesting. So you apply, you see if you're in the range and the expectation. You said we kind of have a process that goes and checks the QuickBooks. Do you take when you don't ask for their churn rate and your MRR and all of that, and some companies at 1 million ARR don't really have SaaS metrics yet and SaaS accounting and so forth, but you can get it from their QuickBooks is what you're saying,
Yeah.
or get
Yeah.
enough.
With
Yeah.
that, we can pull a sales by customer report. And, you know, many founders have it as well. When I say
Okay.
what their churn is, they're like, click of a button, they can send over the report, and
There
they're
we go.
already tracking it.
Yeah.
But yeah, if they want us to calculate it or they already have it on hand, we're pretty flexible. It's not a rigid underwriting process. And throughout, there's humans involved.
Okay.
It's not an algorithm that just spits out yes or no, we can do the deal. It's conversations with our investment committee
Okay.
and
Thank you
and
for
working
that.
through it.
Yes.
Yeah.
And you're also saying they don't have to be perfect with perfect financials and perfect metrics and, perfect ranges for each of those metrics, right? This is a conversation. But you are looking for something that you can get behind. Is I've described this as you're kind of building a factory of customer
Mhm.
acquisition and customer retention and value and software building and all the rest of that. Early on, it's kind of messy and it's not very
Yeah.
predictable. And
Mhm.
at some point, the larger you get, the more of a factory and more predictable, more measurable it is. At what point is it measurable enough and, let's say, repeatable enough,
Mhm.
right, to start having these kind of conversations?
Yeah, do you have like a sense of have a majority of your customers had the option to renew or cancel? That's a big
Ah,
one,
have you been
where
through
it's
the
like,
cycle?
hey,
Yeah.
have a ton of revenue. I'm 12 months in, but 90% of my customers haven't had the option to renew. Well, that's really hard for us to qualify, say, a 3 to 4 year loan for
Yeah.
something like that.
Okay.
Um, so that's one aspect. And I think most importantly would be having a clear use of funds. Like you've tried maybe a marketing channel that's already producing, or you'd like to hire an account executive and you have an onboarding process set. I think that's the most important because ultimately, like you said, you want to have an ROI. With whatever the term, whatever the cost of your debt might be, having a plan to achieve that return on the investment is key.
So it's not just an ROI for you and your funding and all that. You have an
Mhm.
ROI, but the founder has an ROI. It says, my business is up and ready enough. And if I added a little more capital to do something, hire a salesperson, I can see that over the next 18 months, we'd get in a better place and we'd be able to pay back the loan and be in a better place overall. Like it's an ROI for the founder. Unlike
Yeah.
equity funding, it's not an ROI about equity, right? It's some
No.
other
Yeah. You'd
crazy
go,
app.
like, Map Anything, right? They get acquired for over 250 million. That was we didn't have an active loan with him, but there's no incentive, for us. We don't have any of that equity upside. So yeah, more about an ROI for the founder and him or herself.
Okay, so let's just talk about this. It's a debt-like instrument. Do you have covenants? If you are a bigger company and you want to raise 10 million in debt
Sure.
from one of these big debt providers, there's a lot of covenants
Yeah.
that say, you're betting your house. We'll take the company if you don't pay. If your cash goes below this or something happens, if you hit a speed bump in your metrics, right? Everything changes.
Yeah.
Do you have those kind of covenants that they're kind of life and death covenants for a lot of serious debt out there?
They really are. Depending on the provider, of course. Our covenants that we have, so it's only applicable if you're looking at $1 million or larger loan,
Okay.
is a cash covenant of 20% of whatever we give you.
A
So, if we lend
requirement, you would
someone,
say. Uh-huh.
$1 million, we want to see at least 200K of cash on hand during the term of the loan.
This podcast is sponsored by my friends at Lighter Capital. In the last 15 years, Lighter Capital has helped over 600 software and SaaS founders secure simple, non-dilutive financing to grow a little faster without giving up any precious equity to investors. I know the Lighter team well, and several Bootstrap founders they have helped have already shared their success stories on this podcast. Simple debt funding from Lighter Capital can range from $50,000 up to $10 million with straightforward terms, no personal guarantees, board seats, or covenants, and up to a 4-year payback period. Go to lightercapital.com, that's Lighther capital.com, to apply and get a quick pre-qualification. Then talk with their experienced team to create a practical funding plan to achieve your goals. Now back to our podcast. You want them to spend it, but you don't want them to be bouncing on the bottom, risking their business.
Right. Yeah. If we lend $1 million and then in 6 months, there's less than 200K of cash on hand, it's more an entry point to us to start having a conversation.
Right.
What we don't want to do is immediately call default, right? There's minimal cash in the business. That's not a good situation for either party. So, and we've had that before, right? And that's an entry point for us. Okay, what's going on in the business? Could this be seasonality? Could
Mhm.
maybe an investment not have worked out? Uh, did you have to lay people off and maybe pay out severance? Like, there's a variety of reasons why, like, that covenant specifically might be breached. And we really want to be that partner of,
Yeah.
okay, let's understand this. Let's work on a resolution. Because at the end of the day, what we don't want to do is have to call default right away, and
Yeah.
that's why we've been operating since 2010,
Yeah.
because we work through those situations as opposed to
Right.
blindly calling default.
Or have an algorithm simply do the math or something like
Hmm.
that. All right, so let's talk about the use of funds. When would somebody consider using this? I could add a salesperson. I mean, the simple thing is I could do more of something that's working. I could do a little more paid ads if there's a great
Yeah.
ROI. Sometimes that happens. I could add a salesperson. What other things are spending money on that's more of what's working? Doubling down.
Yeah. I think recently it's been a lot of AI initiatives. There's a cost associated with all those tactics, and some of it might even be experimentation, right? I think that's where a lot of founders and companies might be because it's always evolving. So AI initiatives is a big one. I think another big one is that transition from founder-led sales to really giving the keys to another VP or someone else in leadership, right? Because you'd be shocked. There's companies in our portfolio when we initially started working with them at 5-6 million in ARR, and they don't have a salesperson. It's all still the founder.
Oh, I'm not shocked. I've seen it.
Yeah,
And
yeah,
it's amazing, to be honest, right? Look at
yeah.
how far they've got. And usually that have a team and, a leader of sales and all of that happens later than 5 million, right? I get it.
Hmm.
So sometimes it's adding a leader. Sometimes it's that innovation to go do something. Is it like I've got this idea I always wanted to do, and there's not space in my team and my P&L right now to do this in my cash. If I had some extra cash, I would, you know, try this thing. When is that innovation experiment underwritable, right, with the
Mhm.
loan, and when does it not make sense? Maybe that's more equity. Is it just if you can see that there'll be an ROI within a reasonable time frame?
Yeah, I mean, it's hard to say. We don't have specific restrictions on the use of funds.
Yeah.
When I talk about having a plan and a return on the investment, those are, I think, the founders that we work best with. But, the benefit you get with a longer term loan like we do, a 3 to 4 year loan, you do have the ability to pivot.
Ah,
Of
imagine
course,
that.
yeah, yeah, yeah. Of course, there's founders that they try a marketing channel and it completely didn't work, right? But because the payments aren't very aggressive, you have the ability to pivot during the term of the loan. As opposed to a structure that might be 6 to 9 months, right? At the same
Quick
loan
payback
size.
with your
Yeah.
yeah,
Yeah. You can't really afford to make mistakes,
yeah.
in a structure like that.
And what is a
Um,
normal payback kind of thing? Is it, I take a half a million and I've got a several $1,000,000, software company, I take a half a million in non-dilutive debt funding from Lighter. Do I start paying back right away? Is it a sliding scale or, lump sum at the end? How does that work?
yeah. So it's monthly payments over the term. So
Like a mortgage,
typically,
like it's a kind of a straight line.
yeah. Yep.
Okay.
Same payments. Like if you had half a million, maybe over 3 years, we charge about 1.3 times
Yeah.
that amount.
Yeah.
And then we divide that by the total term to get, whatever your monthly payment might be. So a 500K loan standard for us would be like a $18,000 monthly
Yeah.
payment, give or
Yeah.
take.
Yeah. So you've got to understand your financials, understand your cash flows. Is this like somebody who really gets accounting in cash and has tight books? Because not everybody does as they get started.
Yeah. 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 I get the question a lot, do we need audited financials? And I say, absolutely not. We've seen everything. We work with very
Sure.
early stage companies and
Yeah.
later. So what's actually great about Lighter Capital, what I appreciate maybe most outside of, doing deals and seeing acquisitions or exits, it's the ability if something is out of place. Let's say the company's burning too much cash for us to move forward. We give them very clear milestones of what we need to see in order to revisit this. So
Yeah.
maybe it's, hey, if you reduce expenses for the next 3 months by $10,000, you seem like a great potential fit, but just right
Yeah.
now the burn's too high, or
Yeah.
similar things with churn. So I think it gives them kind of a guiding post,
Yeah.
throughout, because it's very black and white, what we do at the end of the day.
Yeah, right. Unlike the funding side here. So let's compare a half a million in debt funding to a half a million of maybe seed funding from a little venture
Sure.
fund or
Yeah.
angel funding, more likely with verticals, inexperienced founders, or even funding from the founder, writing more checks into the
Yeah.
business, that kind of thing. What are the benefits of, we'll just start with that, the benefits of non-dilutive funding and using Lighter to fund that?
Yeah. And if I'll expand a little bit more on Map Anything, actually, because
Hmm.
I don't think he got into the early stages of the funding process maybe as much. Map Anything eventually sold for 250 million, and did raise VC. But he came to us, and when we did kind of an exit interview at the time, he was looking at seed options for 600,000,
Yeah.
and he would have to give, 30 to 40% of the
Yeah, that's
business
right. He
at the
talked about
time,
that. Yeah.
right? And, I think that's the main difference compared to what we did. And we, eventually did 4 rounds over about 36 months for a total of 1.2 million. So it's really the ability
And he
to.
didn't give up 30% of his company, which
Right.
would have been 75,000,000. in the end, like plus or minus.
Exactly. Yeah. So, you know, especially in the early stages, dilution can be very expensive. You can give away 30 to 40% of your business very quickly. And really, you got to think about the control that is involved with that.
So
When
not
you give
just the dilution that in the end, I want to create this company and sell it, and I don't want to give up as much to other partners if I can all avoid it. But there is something also that comes with, especially institutional investors, that it's more than the money.
Right. Yeah, and it's more than just the percentage that you may own in the business, right? There's governance involved. I was working on a deal with a venture-backed company that was growing really well. We were going to do $3 million with the business. They could absolutely, support the debt, but they were cash flow negative at the time.
Mhm.
And at the final hour of the deal, we're getting loan docs, trying to get them dotted, and the board stepped in, their investors, and blocked the debt, right? Because there was a veto rights, on the debt himself because they had preferred shares, of course, in
Yes.
the business. So, there's things to think about, obviously, when you're capitalizing early stages. And it's not only, I own 50%, so I control the decisions of the company. I think a lot of it is what control am I giving up, even if it's only 20% of my business or less.
Yeah. Well, that's the practical founder story, and all the founders in my peer groups and the ones I talk to, and most of the founders that you've talked to aren't playing the drunken funding game,
Yeah.
and playing that game. But the another benefit that I see when I'm recommending a healthy company, consider it is a founder doesn't want to write more checks into the business, but there's clear investments that would pay off.
Hmm.
Not every investment will pay off, and the world keeps changing pretty quickly here. But there's sometimes some things that we just want to do more of that, and we're kind of cash constrained right now, and it would pay back pretty quickly. So that's what I'm thinking, the double down stuff, right?
Hmm.
When people find something that works.
Yeah. Yeah, absolutely. I mean, and just the ability to have cash on hand and not have to manage cash so closely. What does that open up for, the founder's mindset alone, right? To just
Yeah.
have some extra cash on hand to, go out and hire, whoever they want, account executive, SDR,
Mhm.
because a lot of it can be psychological, right? Where, it's just the ease of access
Yes. Yeah.
into
Yeah.
getting rid of, other things that you're working on, whether that's sales or whether that's just acting like an accountant when you're the strategic CEO and trying to
Yeah.
manage cash day to day. So yeah, it's not only these grand initiatives. Sometimes it's just the ability to breathe, extend runway,
Right.
to look ahead.
Well, I'm sure there's people listening here know that there were, when they're very cash constrained, it's very stressful, and you have a little space, creates a lot of opportunity for them to
Yeah.
think differently. So some founders are saying, I'm at 3 million now. These are founders I know. I'm at 3 million now. There's things at work. I could move a little faster. The faster I get to 10 million ARR and sell it or, take on a private equity, growth equity round or something like that, I'll be better there. I don't wanna do it now. I wanna accelerate and get there. Do you see that or accelerate to sale, right? Like hurry up and grow this thing faster in 2 years versus 4 years.
Yeah. The timing's extremely important. Every
Mm.
conversation I have, this timing of when you're after a strategic acquisition or, maybe it's your first institutional raise or something along those lines. Uh, your question makes me think about Seamless AI, one of our
Eh,
portfolio companies. They came to us about 4 years ago, 4 or 5 years ago, and they told us, I have a term sheet, Series A term sheet with a valuation of 40 million or so, and they were at about 3 million in annual recurring revenue.
yeah,
They ended up doing 2 rounds of funding with us, for a total of $2 million,
instead.
and instead of taking
Mhm.
that term sheet, yeah, they said no. and eventually 5x their revenue, right?
Oh,
And then went on to raise growth equity. And, just the amount of
yeah.
equity value that was saved because of
Hmm.
that decision um, was fantastic. And, I think that's hard to do. Are you raising this round because it's there or because it's an absolute need, right?
Yeah.
And that's really the difference.
Now, I hear this, but I don't know if people think about it proactively. I just talked to two founders this week that'll be on the podcast that said the fact that we were profitable and I managed cash and I didn't have to sell uh, allowed me the negotiation power to double the value, say no a couple times. Do you just does anybody proactively get this kind of SaaS debt to just put cash on the balance sheet to indicate that they don't have to sell and go into an M&A round or potential sale conversations with leverage?
Absolutely. I
Mhm.
actually just worked with a longtime client of mine, and an acquisition was imminent. And they were super
Mhm.
transparent with that. They're in the youth sports management space. It's a software platform for it, and we did 600,000 with them, and 3 months later, it was a 3-year loan. 3 months later, they were like, "Yeah, we just got acquired, and can you give us a payoff letter?" And I talked with the founder at the time, and he said, "Yeah, we're a seasonal business. I knew this was going to happen, and yeah, I know I'm paying you this prepayment option, and maybe it sounds silly that we did this, but he still said this was more important than any kind of prepayment option that you'd have, and he
Yeah.
wanted that flexibility. Because when an acquirer, growth equity, VC, when they see that there's a timeline or an expiration date on whatever your runway may not be, if you're not
Or your burn rates,
capital.
yes, all that, yeah.
Yeah. Of course, they use that as leverage. So, I think negotiating not when you need it, but when you pursue it as an option, it can absolutely increase the valuation or your ability to say no at a minimum.
Okay. When somebody says, I'll go through a couple other examples. I hear all of these. I have a co-founder. They're not doing it. It's not working out. We have a buyout agreement. I'd need 500,000 to buy him out. Do you support that kind of use of funds?
If
Recapitalize, taking it or an angel investor out or a co-founder or something like that?
Yeah, I mean, we've done it before. I'd say if you qualify for 500K in total and 100% of the funds are going to be used to that, it's probably not the best fit. We do want the capital on the balance sheet and deployed for mainly growth initiatives.
Yeah.
Uh, but there's always ways that we can explore to get around with. But predominantly, 99% of the deals we do, aren't to
Okay.
buy out any
Right.
older investors or a
So
co-founder
not
or anything
likely
like
is
that.
what you're saying. How about
Yeah.
little acquisitions here? You know,
Yeah.
uh, well, sometimes, yeah.
Yeah, I just did a deal with a company called Moved, and they are for property managers and renters to kind of make that process between transitioning from, getting into apartment, here's the renter's insurance, here's everything you need, and they were really transparent with me throughout the process that they were going to potentially look at a very small acquisition, probably 3 months after we closed the deal. And what that process looks like for us is we just need visibility on what that acquires financials look like, right?
Yeah.
For the most part, we'll approve those things because usually it's,
Yeah.
kind of incremental growth. What we don't want to see obviously is you achieve 100K in new ARR and then take on, $2 million worth of expenses, right?
Yeah.
But most of the time, these practical founders aren't. So yeah, it's something that we can do, whether it's a part of the use of funds or whether it's you have a relationship with us already. You just need to make sure the lender is involved in that process.
How do you underwrite and rate the seasonal businesses selling to school districts that buy once a year in the fall, and then we have the EdTech winter of cash flow. No new cash coming in the spring and winter, or seasonal business, snow or lawn care software or something like that that hasn't figured a way around their seasonality. Can you bridge the seasonality gaps if you have enough confidence and, I guess, retention or something, right?
Yeah, we'd look at it like say the burn rate or the cash flow of the business from the last 12 months or like a yearly view, so we get a full picture of the business. EdTech, absolutely, they get 90% of their revenue in
Uh,
August or September, and it can
yeah.
be really hard to capital plan in that sense. um, but yeah, we look at it from a yearly standpoint, and we can smooth out any seasonality within the
Okay.
business.
Okay. Well, those are a lot of use cases, and it's very practical. It's not for everybody, clearly, to,
Mm-mm.
think about this or need it. And it's not for the wild and crazy adventure stuff. It's pretty predictable. You got to pay it back kind of stuff. And this is quite serious stuff. When does it not make sense? Just to repeat here, what's not likely? You get talk to a lot of founders, and what's not likely to get a thumbs up, just so people have an understanding.
Yeah, if you're seeing declining revenue trends, we do not need to see VC scale growth by any means, but if we see consistent declining in revenue, that's really tough for
Okay.
us to underwrite towards. A very high churn environment, right? If your gross logo churn is over 50%, that might be a little bit difficult. Or if your true revenue model isn't recurring, at least from a majority perspective, that might be difficult as well. But yeah, there's a variety of reasons that we might say no. And sometimes, maybe it's a business model fit that completely doesn't make sense for us. Like you're in a blockchain technology, we can't really do that, or cannabis as another.
Uh,
um, but for the most part, if you're a B2B SaaS company, we can tell you if we can't do the deal today or in the next month exactly what we need to see for us to do the deal, for the most
uh-huh.
part. But yeah, there's scenarios, of course, where we can't do the deal.
What about all those companies that aren't just SaaS revenue by the month or year contracts or credit cards?
Hmm.
They're more transactional. They're marketplaces with throughput and margin, and they're more reoccurring, not recurring, right? There's some consistency there, and it's
Yeah.
not just completely lumpy, but we see what happens when the world changes in the transactional business, the revenue goes away.
Yeah.
But how do you deal with those?
It all depends. I wish there was one answer. I'll
I'm glad it
say,
depends, and I'm glad you can have conversations about this. I'm just
yeah,
yeah, yeah,
yeah. Well, actually, one of our most successful portfolio companies that's currently a client, they're called Recovery.com. What they do is help people who need either addiction care or mental health care find the right facility for them.
yeah,
And their revenue model is highly dependent on advertisers, right?
yes.
These centers, kind of
Uh-huh.
like Google, right? And they apply to get on the first page or, spend money to get on the first page. So absolutely not a pure B2B SaaS model. We started working with them at 300K in ARR in 2017 in a
Uh,
really small, facility. And we kept growing the facility because they were growing. And, today they're over 30 million in annual recurring revenue. And we've deployed about $4.5 million in them or so. Throughout that, they did raise a Series A. It was small relative to their ARR in 2024 for $5 million. But, just to give you an example of, there actually is flexibility and we're
okay.
not just going to exclude people because it doesn't fit this pure B2B SaaS mold for sure.
Right. Well, I know you do a lot of you have a podcast, the lighter podcast for
Mhm.
bootstrappers. You have a lot of content. You do a lot of education. What are the most common misconceptions that bootstrapped B2B SaaS founders have about what you do that are worth talking about here?
Yeah, I think one of them is I need to be profitable,
Mm.
to access debt. Like I said before, 90% of the companies that we work with are cash flow negative. That's completely fine. Another one is I need to have raised VC to access this debt. We get equivocated a lot to venture debt, which really is a lot different than
A
what
lot
we're
different.
doing.
What
Um,
is venture debt, just to contrast?
yeah. So, venture debt, what the SVBs, the bridge banks, CIBCs are underwriting to is a recent equity round. Typically they want to give you, let's say a company raises a $5 million Series A, right? They want to offer a debt facility based on that last round. Typically it's like
Based on the
30
round,
to
not the business. You've got money, somebody else looked at it, we can help you multiply it. How
Mhm.
much did you raise? Here you go.
Yeah, usually
Yeah.
30-40% of whatever they
Yeah.
raised, and it has to be very recent. So right when you get 5 million in the bank is optimally when they want to do that venture debt round, right? So they're underwriting the investors and really bridging you to another round, right?
Mhm.
So what we do is actually underwrite the business, and we're not bridging you to another round, even though you can do that. So that's the real contrast. A lot of companies say, "Well, do I have to go out and raise, equity for you to support us?" And no, we don't need to do that.
Good. Anything else about, you know, that you wish they all knew before they pressed apply and had a conversation?
Yeah, I think coming prepared with your plan and kind of what you envision the company in the next 12 to 24 months really helps the conversation. I think the underwriting side of it is fairly simple, but really looking for that strategic partnership. And when I say that, what I mean is what I believe to be our best asset is the founders that we have in our portfolio. Many of them are bootstrapped
Hundreds
and
of them
un-
in the current and previous, you know, customer base.
yeah, current clients, we have about 170 or so.
Yeah.
And, as you saw at the CEO summit, it's a unique community, right?
Yeah.
They're competing versus, a competitor that maybe raised 10, 20 times what they have, right? So how do I win against that, right?
Yeah.
Probably what you dig into a lot. But
Yes.
that network of founders that they get access to when you're a portfolio client of ours, I think is extremely valuable. That's why I love the CEO summit that we do every year because
Mhm.
we get 30 or 40 like-minded founders in a room together and they can explore how they did it, what's working, what isn't, and just be really honest about where they are in their business, which I think is unique compared to the, venture-backed founder, who
Mhm.
just raised $100 million.
Yeah. Well, and you had experts there. I came in and helped with some of the peer sessions there, but Gaurav Basin for the M&A advisor, I've had him on the podcast. Some of the guests as well, Darshan and Dave Hirsch was on the podcast as well, who
Yeah.
spoke there. So you brought in some awesome partners, and I know you do some peer group helping across the CEOs in the network, and you guys are very helpful that way. I really appreciate what you guys are doing for practical founders out there and sharing your knowledge today.
Mhm.
What has changed in the last couple of years? You've been talking to founders for a long time. You've talked to thousands of founders and
Yeah.
supported many through the life cycle there. We've had interest rates change in the last few years. Do your interest rates change when, the Fed funds rate changes?
Yeah, slightly. We lend out of a credit facility. The most recent one was from my 80. And yeah, when interest rates rise, our cost of capital can increase. It's a fairly nominal change, for
Okay.
the founders. Of course, what you're getting isn't the rates that you get, say, from a bank, right?
Yeah.
But, for a lack of personal guarantee, for a lack of financial covenants, that there's that trade off there. But yeah, in the last 12 to 24 months, I think a lot has changed, in the sense that I'd say 2 years ago, we noticed a lot more companies. It was much harder to grow. We were seeing, lower growth rates kind of across the board, potentially, higher churn rates as well. And, I think now we're seeing a lot more businesses that kind of right sized and they're now closer to break even. And really they're saying, well, I don't want to go out and raise because I might not be that AI company, but I still want to grow this business in an efficient manner. Right. So what are my options there? And if you're not a founder that maybe can finance the business him or herself, options like ours or debt in general could be a good thing to explore.
So VCs have generally moved on from rule of 40, rule of 60 SaaS, B2B SaaS companies, right? That aren't all about AI. They just have no interest anymore. So that probably has created some demand for you as that thing has shifted.
Yeah.
What about AI inside the company? Maybe it's part of their story. We're getting more efficient and growing faster because we're using AI efficiently. We have AI in the product that didn't take a mountain of funding to create new value for our customers. Maybe it's changing pricing or competitive. Like, are things getting mixed up with AI, the SaaS plus AI or AI first companies that are knocking at your door?
Yeah, I mean, we get about 5 to 6,000 applications a year,
There you go. Look at that.
and yeah, my sales team's probably talking to like 1,500 or so of those. And while many of the companies, have AI components within their business,
Yeah.
we haven't seen a significant kind of wave of these different revenue models, these usage-based models and things like that yet.
Yeah.
I'm sure that will happen, but what I can say from my point of view is there's many fantastic SaaS companies that are still growing plenty year over year that are very capital efficient that are getting interest, from potential acquirers and
Yeah.
exits.
Yeah. It's
So
very
that
active
still
out there.
exists.
So the world keeps changing, but practical founders chug along here. Do you have any founders that are going long, right? They're not trying to sell their company. They're not trying to get to a next round. They're bootstrapped and uh, ambitious. So they're, trying to grow faster. Do you have any of those that, are using your debt to stay independent?
Yeah, one that comes to mind is a Utah-based company called Gray Falcon.
Hmm.
What they do is work with large brands to assist them in get rid of illegitimate resellers. You're Olay, and there's some kind of fake uh, reseller of your makeup or whatever it might be, and they help you kind of legally through the process delist any illegitimate resellers.
On
Um,
Amazon and things like that, you're the
yeah,
brand and you're trying to get
Amazon,
rid of the
Walmart.
knockoffs, right?
Yeah, yeah, exactly, knockoffs. And we started working with them in 2019, and there's three founders. And what they've done is strategically use our capital over time. So we started off at $100,000 with them, and speeding up to Q4 of last year, we've deployed about $4.2 million with them, and they're a fantastic business, growing well over 40% year over year. I believe just under 10 million in ARR or
Mhm.
so. But what's interesting, when I talk to them is the PE groups, the growth equity groups, the VCs, they come to them. They're like, I'm inundated with these capital requests, and that's because they've built something that's profitable, right? And that's hard to
And
do,
growing.
and
Yeah,
there's value in it, right? While still
yeah,
growing. So, I think it's a great story, and they have so many different decisions they can make in front of them, or they can just keep doing what they're doing,
yeah.
which I think is awesome.
So they use the lighter debt, I presume in multiple rounds, right, over
Yeah.
time to preserve their independence and their optionality, right? So they paid for their independence, right? Their right to say, we get to do it our way. We get to decide what we want to do with this, which is the most valuable thing for founders to be able to, control the company, control the aim, do it their way, and not listen to somebody who's making shorter term or spreadsheet decisions for them,
Mhm.
on the investment side. Speaking of spreadsheets and algorithms and all of that, how much of your underwriting process is in the numbers and how much of it is in the conversation with the founder?
Yeah, we have a credit risk kind of algorithm. We plug in all of these things, but what often happens, like, I'll tell you a scenario where a company has higher churn than what we'd like. Maybe it's
I'm
40%
shocked.
or
Yeah.
something along those lines. What can be kind of more anecdotal outside the numbers is, well, the founder has on purpose been churning out lower value, maybe lower margin clients in order, to
Yes.
go more up market. Those are things that we absolutely, want to account for when we're underwriting,
Yeah.
and not just, make numbers in and then numbers out.
So you can
Um,
look at the cohorts, the segments, and say they found their ICP, their newer customers are churning out at a lower rate, they're letting go of their other customers, which great cash issues, there, but
yeah.
you can see where this is going.
Yeah. I mean, there's definitely a human component to what we're doing, right?
Mhm.
Obviously there's credit standards that we need to maintain and facility requirements, but at the end of the day, we're having conversations with the founders. If it's a larger deal, you're going to speak to my CEO and my head of credit. Not to go through a due diligence list, but to get to know you.
Yeah.
Because on average, the relationships that we have are about 4 years with these
Yeah.
businesses,
Yeah.
so that's a long time, and their needs and aspirations might change a ton. So we wanna have a really good baseline of understanding them and their business, before we do a loan. So it's not funding in 48 hours by any means, but,
Yeah.
it's funding in, 3 to maybe 4 weeks, right?
Yeah. Relationship funding,
Mhm.
like a little bit like the old days, but you're doing it for the SaaS founders that have this way better business model than most of the ones that are out there. Well, I really appreciate you sharing your insights here on the Practical Founders podcast, about the when it's a good fit and what actually happens and what misconceptions and mistakes are made out there. So I really appreciate your sharing your knowledge there, Tanner.
Yeah.
As a last kind of question for you to share some wisdom with practical founders, if you were a SaaS founder these days, what would you be trying to create in your business that would make your debt offering the most useful? Would you be getting good accounting books and lowering your churn rate and trying to be a rule of 60 company? Or, what would you do before you came to Lighter or anybody else to make sure that it would be a great investment for you?
Yeah, financial hygiene is one aspect, but, if I were in their shoes and didn't live and breathe debt, I'd wanna talk to their customers, right? We have a list of clients, in our on our website, right?
Yes.
And I'd wanna poke the brain on what worked and maybe what didn't work when they utilized the debt,
Uh,
right? And really get an understanding of what it's like to work, not only with lighter capital, but with any debt provider,
yeah.
right? And I think that's important because longevity, in this game, people can come and go in the
Mhm.
capital
I've seen
markets,
that.
right?
Mhm.
You can make money very slowly, you can lose it all overnight, right? So working with someone who has a track record and a pedigree and has been there during the hard times and the good times, I think is important. And secondly, the financial hygiene, of course, is a component of it. But I don't know. Does that answer your question, Greg?
Yeah, that's good. So you're saying that founders should understand the game that they're playing with debt if they're ever considering it, and do the due diligence, with the customers, of anybody they're considering to make sure it's a good fit for them and they're going to be a good long-term partner. It's a partnership just like equity funding
Hmm.
and all of that. So thanks for partnering with so many practical founders to get them to their successful exits or long-term success stories. Really appreciate you being on the Practical Founders podcast, Tanner.
Absolutely. No, thank you so much for having me, Greg. I appreciate it.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.